record on the script. You see, so I've started recording now, and the question is very simple. The question is, so far, have we tried our hands on this support resistance or the psychological level things? And if we have, are there any difficulties that we're facing that would need a little bit of explanation before we move on? So I'll open the floor for about 5 minutes, and then if there are difficulties, then we can just trust them, because we are almost there now. We are literally almost there to be able to start trading. Once we've done indicators, we go into strategy. And then as we do testing, we're trading. That's all it is. So if there are any difficulties, we should just trust them right now. And then once we've done them, then we know that we can all get up to speed and then go into the next phase, which is just indicators. We're doing indicators today. And once we've done the indicators, we can then get into strategy. Okay. All right. The silence means that probably everything is up to speed, which is fine. Okay, so indicators. What are indicators? So indicators are really tools, right? Tools that comes as a result of calculations which people have done in the past, or calculations which people have computerized, or just things that we use in the trading environment to be able to help us confirm the direction of price. Which means that when we say confirm the direction of price, let's say we've looked on the charts, and as we've looked on the charts, we've seen that, oh, price is likely to go somewhere. But then we would need some other things to also say, oh, based on what we are thinking, these other tools can also point us or help us to that direction. For example, let's say you are not feeling well. You go to the hospital, and then you talk to the doctor, I'm feeling this way, I'm feeling that way. So the symptoms mean that maybe you've got the flu. But then also, let's take your temperature. So they need a tool, like a thermometer, to use to take your temperature, to ensure that, oh, maybe if your temperature or your body heat is up to a certain level, it could show the sign that you've got fever. Or maybe there's, so let's put a stethoscope on you to see your heartbeat or your pulse rate and blah, 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 to see if it's normal or it's not abnormal. Those things are all like tools which, the doctors use based on the analysis of what you've told them. And they use the tools also to confirm. Sometimes it could be a blood test, it could be urinal test, it could be those other bits that they have to use to confirm possibly what they think might be wrong with you. You understand? So in trading, we also normally, we can use this support resistance, or what we call the psychological levels, to be able to just help us create a perception. There's someone, this thing off mute. Can everyone go back to mute, please? Can everyone put their mute buttons off? Because I can hear people now. Oh, it's not mute. All right, so in trading, we also need tools, which when we supposedly have analyzed price actions, we can then almost say that, oh, it looks like price is going to do something, or price is going to move somewhere. But then we need some other tools to also help us to confirm, or we call it create confluence, that price is likely going to go to that direction. And I'm using the word likely. We can use the tools and everything, but sometimes price would not go the direction. So the tools help us to be able to almost like confirm what we believe to be true, right? So there are different indicators in TradingView that one could use to help them trade. You know what I mean? So for example, if you want to know where the TradingView, this thing, indicators are, you can see that here, we've got what we call indicators on the top here. So we click on that one, there are many indicators. These ones are my favorite indicators, indicators that I have started or I've used before, our favorite indicators. And then these are my scripts. Scripts are computerized programs that one has personally created and kept there. This one was created by someone, and then a friend of mine. And then there are other ones, indicators for technical analysis, different. There are many different indicators. And so therefore, I will be introducing you to my indicators, yeah? The indicators that I have used before, or indicators that are popular out there that people use. And then we can also individually go and look at indicators that people are using, and then you can bring it on board and we'll discuss them. Okay, so one of the indicators that I use the most is called the moving average. All right, so when we say moving average, what moving averages does is, let me take this off. What moving averages does is, moving averages looks at the average pricing per where the candlestick ended or closed. So look at the average price of each candlesticks where it closed, and it will add them up and create an average. Do you understand? And then when it creates the average, then becomes a line. It plots it as a line. Now, moving average, if you're telling moving average that you want them to create that line, you should indicate how many candlesticks you should be adding up to create like the points where it will connect the lines. So in moving averages, for example, let's go and pick a moving average and then we will edit it. Moving average. Okay, this is a normal moving average. So, okay, that is the one. Once I click, it comes up here. So let's pick this one. In this, the input that is already there is 9. As you can see here, the input is 9. Meaning that what it does is, you add this 9 moving averages. So the first candle, off this. The first candle, let me just expand this candles, then you can see them. All right, so for example, this candle, the red candle over there, where it closed, and that one, that's 2, 3. Because this one I've not closed, it wouldn't bother with that. So this way close 2, 3, 4, 5, 6, 7, 8, 9. And then it will add all their moving averages and then they put a point somewhere. Do you understand? And then it will continue. Take this other one, 9, and then add, give an average. So that is what creates this line, this number 9 moving average. And what that does is it creates a line which tells you that the price that where it all closed is creating some kind of trend. You understand? So for example, people can either decide that they will be using the moving average as a way to confirm the direction of price. Okay. So this is a common normal moving average. There's another type of moving average which we call the exponential moving average, which is the EMA. So we have the MA, which is the moving average, and then we have the EMA, which is the exponential moving average. The difference between the exponential moving average and the moving average. So let me just make a quick note here. Text. So we have the moving average, and then we have the exponential moving average. Okay. So what we are saying is the difference between the moving average and the exponential moving average is that with the moving average, it will just take the closing prices easily and then just calculate it like a normal, this plus that, plus that, plus that, divided by the number of candles. But exponential moving average, what it does is it adds more weight to the current candles than to the previous candles. So maybe you are adding 9 candles on an exponential moving average. You would realize that what is happening by computerization is that maybe the first 5 would then be maybe weighted at a higher rate than the previous ones. Meaning that, let's say we've added 10 of 9s, maybe 10, 10, 10, 10. It gets 90 divided by 9, you get 10. But really speaking, if the first 5 is 10, 10, 10, they will add a weight. They add a weight into it. That those one becomes pronounced in the curve rather than the previous 4. You see, so the exponential has a more up-to-date kind of closeness to the price action than the normal moving average. Now, so generally, people tend to use the exponential moving average. And they tend to use the exponential moving average when they are dealing with price action, which is on a lower time frame. Let's say from the 4-hour, 2-hour down. If they are dealing with a price action greater than the 4-hour up, they will be using the normal moving average. Because with that, we are looking at the long-term period. So the normal average, which is the normal moving average, it's okay to use. But if you're looking at relatively lower time frames or shorter time periods, normally people will recommend the exponential moving average. Now, this is the moving average. Let me go and find an exponential moving average. So we go here to the indicators, and then we find exponential moving average. I think I've got one here already. I've started one. So let me click on that one. And then let me see what I've typed in. It's also 9. You see, that is 9. Let me change the colors. I think that would help if I change the colors. Visibility. So to change the colors, I'll go to style, visibility, and then you pick a color. Let's make a nice yellow. All right. So, so this is the moving average. Okay. So the moving average is the purple, right? And then the exponential moving average is the yellow. You can see that although they are both 9, and I'll show you, go into the settings, input, it is 9. But this is a normal, moving average. And then when you go into this other one, which is the yellow, that is the exponential, that's the EMA. EMA is exponential moving average. And then when you look at the input, this is still 9. But because they add more weight to the current numbers, you realize that that one is closer to the prices. It's closer to the prices than the purple one. Do you understand? So people would just normally say that if they are dealing with the lower time frames, they will rather be using the exponential moving average, which is this one. Right. Now, the question is, how do we use the moving averages? How do we use it? So for example, let's look at this one. Let me go and edit it and make it 5. Okay. I'm editing it to make it 5, which means it's calculating just the 5 candlesticks for me. And this one works on any candlesticks, meaning that if it is a 4-hour, each candlestick is 4-hour. It will work. If you go to the day, each candlestick will be a day, and then it will work on it. It works on every form of a time frame. You know, so what I'm just saying is that, let me just take this out. What I'm just saying is, let's go back to the 4-hour. Let it look a bit bigger. What I'm just saying is that, let's say we put this one, the exponential moving average, as 5, which means it's only calculating 5 days. But how is this used? How does this help with trading? Okay, now, let's say we've done our analysis, right? Which we've gotten to a psychological level here. Yeah. And when we've gotten to the psychological level, we realize that we have a tweezer. This red and this green, we have a tweezer. on the psychological level, meaning that we expect price to start going up because we've got this, that, which is a twist. We expect price to start going up, right? Some people would also use an indicator to confirm the direction of price. So for you to use an indicator, then you could bring in your exponential moving average, the 5 exponential moving average. It could be the 8 exponential moving average. You can put different numbers. Certain people have tried different moving averages, which works for them. And so let's say I am using the 5. Now, from the 5, you could see that the moving average is in the middle. The price action, next price action was right in the middle of this. What I'm doing is, what I'm waiting to do is, anytime that I see the candle print above the moving average, it is a clear confirmation that we are going up, right? So somebody can say that, okay, fine, I've got these candlesticks to tell me that price is likely to go up. Now I can wait on the moving average until a point where I've seen price printing directly or price closing directly above the moving average. Then I can start going out, like what we see on this one here, on this candle here. On this candle, you can see that this candle closed clearly above it. And then all the candles started closing above it. And it started going up, So we use that as a way to confirm our bias that, oh, this is likely to go up. So that is that. Some people also use 2 forms of the moving average. So they use 2 moving averages on the same trend. One is a lower moving average calculation, and then the other is a little bit higher, exponential moving average calculation. For example, so we're talking about exponential moving average to cover the point. So for example, this one, I've got 2 EMAs here. Let me take these off. I've got 2 EMAs here. Let's see what this one is. This one is a 10. And then let's see what this one is. This one is the 5. Okay. So we are going to put the 2 together on there and then use it as a guide. Okay. And then to use it as a guide, let me take the price action off, and then we'll explain what we are expecting to see. I've taken the price action off. I've left just the moving averages. Okay. And what we will normally do with this moving averages is that anytime the blue line is below the red line, it means the price is going down. Anytime the blue line is above the red line, it means price is going up. So you can see anytime we see the blue line crossing the red line, which is the blue line is the 5 moving average, the 5 exponential moving average. When we see it crossing the red line, we expect price to be going up. Anytime we see price, the blue line crossing the red line, we expect price to be coming down. Now, let's come to this place. Here, for example, we saw that the blue line was crossing the red line. Let me put a line there, and then let's see what happens there, because it is around what a psychological level. So let me put this line there. Let me find it nice white line. It looks very thick. Okay. Okay. You see this white line. Now I'll put it there. Let's say there might be a reaction around here because maybe there is a psychological level there. Let me go and put our prices back on. Now, this is the line. Do you understand? We got this our tweezer here, right? And then we could almost see that if we're using only one exponential moving average, which was the 5, which is a blue one, once this candle printed on top of it, we would have gone into the market. But now, because we're using 2 exponential moving averages, we wanted a fuller confirmation. So we had to wait a little bit longer to go into the market here. And then that was a clear way up to the next level. How much this thing percentage would have done with that confirmation? Let's see. It's about how many?
5.45.
It's a 5.45, which is a huge. It's about this thing, a huge pips, normal pips. We're not using trading, so I'm not going to use the word pips. But then this is the percentage that's gone up. Now, so certain people, based on their risk threshold, will rather be trading with two different exponentials, just so that they can get full confirmation before they go into the market. Certain people, they want to take, they don't mind. They just, when they see their signs, they rather would use, how we call it, the 5 exponential moving average, or maybe 8, or some exponential moving average, such that when they see, like, we have this bottom here, price, this almost printed at the top, and then they would enter the market when the price closes straight away. They rise there. Let's see how much we would have made if we've taken that thing. That is 5.99. So you make like an extra 0.4 on it based on this thing. But it is an individual preference, you see, and that is moving averages. You see, so you can use the exponential moving average when you are looking at shorter time frames. That's exponential. When you're looking at very long time frames, like greater than the 4 hours, you can use the normal moving average, that's the MA. So when you see EMA, that's exponential. When you see MA, that is moving average. Okay. All right. So now let me show you another indicator. Let me take this one off. Let me take that off. Let me take them off. Let me reset the chart. Now, another indicator that we can use, we call it a momentum indicator. It is called the TSI. And we'll go and find what that means. I've forgotten what that means. So TSI is an indicator. We are actually trying to computerize it and program it properly so we can use it for trading. It's a very good indicator. So the TSI, it says with this thing, histogram and MA. You see, we've got MA here, which is a moving average. Do you understand? Which means they've included things in it, like they've employed a moving average in there. You know, so TSI, I don't know what that means, but we can go and find out what that means. Okay, so let's go to Google quickly and say TSI indicator. TSI indicator, meaning maybe they might give us, oh yeah, true strength indicator. That's what it means. True strength indicator. The true strength indicator is a technical momentum oscillator used to identify trends and reversal. Okay, that's fine. So you can take this as your definition, and you can just go into Google and go and find the meaning of TSI, and then keep it for yourself. All right, let's go back to the charts. Now, on the charts, so this is the TSI indicator. Let me show you something here quickly. Normally, when you bring an indicator on your screen, you can go and then edit it. You know, let me move it. You can go and edit it. So we are going here and then we are going to set it as default. So when you have default, this is how it looks like. So we are going to set it up, okay? So we go to indicators, we look at the style, we just change a few things. This one into histogram. And then let's look at input. I think it's 16 and 12. Yeah. All right. And then let's go and edit something else. And don't worry so much about this. We are recording it. So, and if you have issues using TSI, I would help. So if you're missing something, go back and record it again. Look at the recording again. So let me show you where I went. So you can see TSI here. And then there's the settings. Click on the settings. Input 113 and then 12. And then signal, I think signal should be 3 or so. I'll verify it later on. And then let's go back in there again. Visibility. And this visibility, we still have the same visibility. So let's take that off. Yeah. We are taking the TSI histogram off. So TSI signal, we've made it histogram. Yeah. And then I think that is that. Basically, we could take this moving average, TSI moving average, we can take that one off. As simple as this. As simple as this one. Okay. I hope we can see how it looks now. Now, so what we are trying to do is we are going to see if we can put some lines in it. I'm not sure, but let's see. Let me go into settings and see if we can do that. Visibility minute, blah, blah, I don't know. Input. Style. Okay. All right. That's fine. Let's give it 60. And then 60 minus 60. Okay. And I'll show you where they are saying. All right, this is the 60. This is the minus 60. No, I don't think this is that 60. So input. Style. Yeah. Okay. No, let's bring it down to 55. Why is this still not changing? 40. Let me test something. 35. Okay, it's changing. So let's go. We'll go. Put it at maybe. Let's put them at 50. And this one minus 50. I think that's more comfortable. And you can tweak it, yeah. All right. So that is what it is. So this is the 50 line, the red at the bottom. This is the minus 50 line at the base. Okay, so what we are just doing is a simple thing. We are going to use this indicator to help us determine that the direction that we've determined on the chart above, is it likely that it would happen based on what we expect it to happen, right? So let me expand this so we can see the candlesticks very clearly. Now, I hope we can see the charts clearly. Okay. Yeah, so that's what it is. So let's go back a little bit. We were here. Yeah, we had a tweezer, right? When we had a tweezer, we can see that there's a clear bend here. But where is this? What if we are connecting? Also, let's say, let me go back. We had a tweezer here. So which in these two candlesticks tells us that we are about to go up, okay? So let's put a line or a cross where we expect to go into the market. We expected to go into the market there, at that cross. Let's do it a white cross. Right, we expected to go into the market there. You see, so when we expected to go into the market there, we could use the this thing, TSI, to tell us that we are about to go up. Are we about to go up? Now, what we could do is we just connect. You see the 50 line, we take a line and connect it from that to the next line. Meaning, therefore, that the bottoms or the bends of the TSI to the next bend should give us a clear direction. That if we are in the same direction that we expect to go, after we've had confirmation on the candlesticks, then it is likely that it will take us there. Do you understand? So for example, this one at the top, we got to here at the top, we had a tweezer top, and it broke this thing. We expected to at least go down for some time. Can we find something on TSI to tell us that this thing is about to go down to the bottom? We can just take a line, look at the top. Normally, When TSI is around the 50 zone, it helps. But let's take a line and connect it all the way from where we were, the top where we were, to this where we're. The direction of the trend on the TSI tells us that we are likely to go down because of the direction of the trend. Do you understand? But then we have to always confirm on a support, or on a psychological level, on a support, on a resistance. So we came here just to the midway, possibly, and price retrace again. When price retrace, maybe if we had traded this, we could have taken a profit. Let's see how much profit would have made from there. Would have made possibly just halfway. It's 2.45. A 2.45 is good. When you're using leverage, you can get possibly 10% from your trade. And normally you don't expect to make all the money that you need in the world in one trade. So you have to manage your trade. You have to be disciplined, and then you trade. So the next opportunity that we had was there. This tweezer top here. So this gave us a clear tweezer top. We would have gone into the market here, and we would have expected to take our profits there, right? The question then is, what would be a clear sign for us to know that we can go into the direction that it says we can go? This was the top. This was the tweezer top. So let's connect again and see if it's in the same direction. So we look at the dot before, right? The dot that we had before to the point where we are now. We got to this place. You can see clearly that the direction tells us that the trend is going to go down. So once the trend is going to go down, you can go into the market because you're using this to confirm your direction. Do you understand? So your direction, you were on the psychological level. You had the candlestick to tell you that, oh, we are likely to go down. You look into this, and then it tells you we're going down. Sometimes, if this is not clear, you can skip and go all the way back there. And it tells you that you are going down. So either that or that, it still tells you you're going to go down. And then you trade it. You take your profits closer to this thing. Because it started here, you couldn't have taken your profit there. It's just there in the middle. So you take it at the end. Do you understand? And once you've taken it at the end, you can see right, you finish taking it. There's another clear bottom here, which tells you that. Well, there's another tweezer telling you that you're about to go up. Now, if you're about to go up, where would you connect it from? You connect it from the bottom of the trend here. So we are looking at, we are about to go up here at this level. At this vertical level. At this vertical level. So the question is, if we are about to go up, how would you connect to know whether we are going to go up? Look, we're on the 50 line. Let's connect it. It tells you that the trend says I'm going up. So because the trend says I'm going up from the bottom, you can go into that trade. And then, excuse me, it takes you up to the psychological level. We have this Marubozu, very big one. It was so close to the psychological level. So obviously, we couldn't have done anything with it. You know what I mean? So we only have to wait to find a clear opportunity. We found something here. The fact is, this one was not close to the psychological level. So possibly it could be a risk, but you can still take it. If the profit to your your profit ratio, your profits to your risk to your profit ratio is good, you can calculate it and take it. And I'll show you how to calculate those ones when it comes to strategy. Okay, so this is it. So let's keep going. So this is the next, let's say this was the next opportunity, right? Because of this clear bullish engulfing candle. Then the question then is, if this was the opportunity, would have gone in on this red candle, right? So this red candle will just start and would have gone in. The question is, how would we know? Is the direction telling us that it's going to go up? When you connect it to the bottoms, it tells you the trend that it is likely it is going to go up, and then you go into it. You know what I mean? So then this serves as a guide. Like this one is a huge Marubozu, so I would never even bother when it was very close to the psychological level. meaning therefore that you would leave that trade. Do you understand? Here, it's in the middle. It's not close to the psychological level. So normally I wouldn't trade this. Normally I like a clear direction. Because it's in the middle, it could come down. But let's say someone takes a risk and they wanted to trade it. How would they trade that? This tweezer finishes, they would enter in this, they'll enter on this candle, this red candle. Yeah. So if they're entering on this red candle, the question then is they need a confirmation. So if it is coming down, we have to go and connect from the top. Then I'll summarize this thing. Connect from the top where the candles that you see, so the very top here to where we entered the market will be there. It tells you clearly that there's going to be a downtrend based on what you can see. And then you go into it. It takes you back before it brings you all the way back up. It takes you back because you see, and that's the danger with trading, not trading on the psychological level. If it's in the middle, it can likely take you all the way even back to the psychological level before bringing you to your destination. The point, therefore, is if we have something we call stop loss, which means that if the trade is not going your way, the stop loss will just close your trade for you. And then we have something we call take profit. We will do it on strategy, okay? But we would understand why certain trades you might not want to take it or you might want to take it. It's normally a personal preference. It's everybody and their risk appetite, okay? Yeah, so then that takes there. Now, the last one, and this one was, I think, last Friday. I should have waited for this candle. I didn't wait for it. I jumped into the trade. I jumped into the trade somewhere there because I should have waited for the candles to close. When I think we were somewhere there on this candle, on this red candle, it went all the way up. So I was assuming that, oh, this candle is going to close. It started at 1 o'clock till about 5. So I was like, oh, this candle is going to close positively, and then we can go up. And unfortunately, I jumped into it. The thing did not close. It came and then it became red. So I shouldn't, if I had waited for it to close, I shouldn't have gone into this trade at all. So I was in there. I was stuck in there. And then it did as if it was going to work. And then it went all the way down again until Sunday. Sunday, we had this thing. Was it Sunday? 28 May. I think 28 May. I think 28 was this thing, Saturday also. We were waiting in this thing. We were hanging out in this thing for ages. Until Sunday afternoon after church, I checked my trade and I could see the trade was going up. So when the trade was going up, I've been so frustrated from all the way here that I was like, okay, it's going up, it's in the bill of profit. So I came out here. And then I went to bed. When I went to bed, I woke up in the morning, it's gone all the way to the top. So that is how we need to be very patient. So as we speak right now, we are here. I'm just waiting because there's no sign. When it gets to the psychological level, normally because this is up and it's going to turn down, I expect the price to go down with it. Unfortunately, we don't have that angle which tells us that it's going to go down. Look, we don't have anything that tells us it's going to go down. So I have to wait for the candles to form. Once the candle forms and I cannot use this indicator, I can go and use another indicator. Let's say I can go and use the 5 MA or some other indicator. Where is the EMA? That's not EMA. Yeah, I could use one of the indicators to tell me the direction of the confirmation that I have, but I need to wait. I just only need to wait to get the right candles forming on this one, and then you can go into it. But having said that, though, I've gone into some trades. I'll show you those trades that I've gone into. Just private. I mean, these trades, and the trades are not looking like they're going in my direction as we speak. I mean, AVAX, I mean, BNB, they came down, but they're going up slightly again. I mean, this one, it came down where they're going up. So but I believe that These are all like going to be like retracements, and then we'll head down to the bottom. You see, because what the question is, what did I see to go into those trades? You see, I saw a clear tweezer on Solana, and then I went in on this next candle. It came all the way down, but it's going up again. But I'm hoping that it's just going to continue. Do you understand? I was using another indicator, and then let's look at XLM. You see, I saw this clear tweezers at the top, and then I entered the market here. It came all the way down, and it's gone up again. But I'm hoping that it would come down. BNB, same, tweezer all the way down, came, and I'm expecting that it will go down again. Let's see how my trades are doing. And then we'll look at possibly one more indicator, and then we can go and research on our own indicators. So this is the trading platform, USDT perpetual. Okay, so you can see that I'm in profit on one, I'm in a massive loss on the other, I'm in profit on another one, I'm the slight loss on the other one. So AVAX is where my problem is. So AVAX, possibly, I don't know what happens. It has a clear tweezer at the top on the psychological level, and it looks like this is printing the top, which therefore means that, let's see, it might possibly go the direction I want. But when you look at this thing is flat, meaning that it will consolidate a little bit before maybe it tends to go to the bottom. But we'll see what happens. Tomorrow, hopefully, I can tell you the news whether I made a profit or I made a loss. But then the thing is, where would I put my stop loss? The stop loss will go just to hide above the psychological level, because the psychological level normally will resist the price from going through. So my stop loss will come and sit at the top here, and then my take profit is somewhere there. So let's look at the risk reward. So I enter the trade here. My stop loss is there, and then my take profit is there. The risk reward is 1:3. You can see it on it. It's written on it clearly, 3.05. So 1:3. If I'm making a profit, I'm making a profit 3 times the risk I'm taking, that kind of thing. So when if it should go and hit me, fine. We've planned that into the trade already. That's what it is. Okay. So I think let's do one more indicator. And then once we've done the one more indicator, then you can go and find different indicators on YouTube, and then we can review them. I'll also find a few other indicators. We'll look at them tomorrow, maybe 3 more. We'll look at them tomorrow, and then we can call it a day, and then we'll move to the next one next week. Okay, so now let's go to the one more indicator. Okay, so now we are here. Reset this. Okay, so reset this now. What we are going to look at is stochastic RSI. So let's close this one, and then let's go and find stochastic RSI. So you go into indicators to look for them. Normally, you wouldn't see all these stars. These are stars that I type. But when you start typing stochastics, this is the one I use. It says Hellas Smooth Stochastic RSI. That's the one I normally would use. Okay, some people use RSI to determine what we call overbought and oversold. Okay. What that means is that the market, or the price actions that you see on the screen, is made up of 2 sets of people. People who are either selling, that's the red candles, so they're selling for the price to come down, or they are buying. These are the green candles. Now, when people buy, get to a point, they would be like, you know what, the price is too high. So we've overbought the market. The price is too high where it is. We won't buy it anymore. We've overbought it. So we would wait for the price to come down before we buy again. And people too, when they sell and the price keep coming down, it gets to a point they'll be like, oh, the price is too cheap. We have oversold. So we'll wait for the price or the people to start buying for the price to go up. So before we sell again, you understand? So therefore, what this indicator does is it determines if the market is either overbought, meaning that people are saying that they've done too much buying and they don't want to buy anymore, and they're only waiting for the price to drop. And then when we get to this other place too, the market is either oversold, which means that now the sellers say we've sold too much, the price has become too cheap. So we are waiting for the price to start rising before we start selling again. So now, let me move this to the top. Move. Yeah. So now, what it is this indicator, what it does is a very simple job. Whenever price goes below the, is it a 50? This dotted line is 50. Let's go and edit it quickly before we continue. So edit, input. So K is 10, D is this, that. I don't even understand what this means. Stochastic length. They've done whatever they want to do. The input, you see, we have the upper level, upper band 80, and then the lower band is 20. The upper band is this one, that one over here, 80, that's here. And the lower band is what, 20? Where's 20? I can't even see it. Okay, 80 is here, but this is minus 80. So where is the 20? Okay, we don't have 20. Maybe it's the same. It's the same as the 20 over there. You know what I mean? And that's the 80, 80, 20, minus 80, minus 80. But I said 20 and then 80. Yeah. So what they are saying is that when we get to this 80 at the top and price is going beyond it, we expect price to start coming down. Do you understand? So it is over bought because it's too much high now. Now, when price comes around the 20 here, below 20%, we expect price to have been oversold and we expect price to start rising. Normally, what then happens is that anytime the price starts to go up and the lines, these are just two lines which crosses, right? And these two lines are the ones we saw here, the 14 and the 14, I believe. So let me just go and find it again. I believe it's this one, the 14 and the 14. It's one is RSI, one is a stochastic length, 14, 14. You know, so when the lines are crossing, which means the blue line is crossing the red line. Let me show you clearly. You can see that when this blue line is crossing the red line, it prints something. It gives you a print to tell you that, oh, the blue line is crossing the red line, which means that now the people who have oversold, there's going to be buying. So we are going to start going up. You know what I mean? When this blue line start crossing the red line down, it prints a top, which means we have overbought. We are now going, the people are going to start selling. So now, how does that relate to our charts? You know, let's find how we can use it or people use it to their charts. So now, assuming we are there, let's go back and analyze. What time is it now? Hey, we've gone very, very far today. Okay, but that's fine. That's one. Let's look at this very, very clearly. Now, let's say we got to this bottom here, right? Here, clearly, we know that, okay, because we've done this tweezer here, we just want to buy the market, whatever, and then we went into the market, expecting price to go up. At that point, what was happening to stochastic RSI? At that point, we realized that stochastic RSI, even though it's in the middle, it looks like it is still going down. So what do? Do we wait? We could have waited. When we wait, it starts turning, right? When it starts turning, meaning that people believe that at that point, they oversold and price should start going up. And then we could have waited. When we see stochastic turning up, then we go into the market at this point, and then it takes us up because it means that people are ready to start buying. Let's look at this one. Here we have these two tweezers, meaning that we expect price to come down. At the same time, where this thing, you realize that there was a point when the blue line started crossing at the top, which means that it has been overbought. So we expect price to start going down, which means this is a confirmation to what you've already established there. When it printed and it started crossing, you could go into the market. You know what I mean? Now look at where we can look, this one, clear, two tweezers. We wanted to go into the market. When we went into the market, what was the indicator? We didn't even have any indicator here. There's nothing here to tell us, except that we knew that the blue was still under this thing was going down. I wouldn't have known what to use this to confirm with. So if you couldn't have confirmed with that, find another indicator that would have given you a clear confirmation. You know what I mean? That would tell you go into the direction. For example, when we're using the TSI, we're able to find a clear confirmation. Let's go to the next one. This one was already, yeah, let's go to something like this, although it's a bit risky. This tells us that we are going to go down. Where did it tell us? It told us all the way there. So we would have waited for this blue line to cross going down somewhere there, and then we'll write it. We'll write it all the way to the bottom. So people would have preferences for indicators. I use the stochastics RSI a little bit differently. I just would normally, like, for example, today on one of my this thing trades that I wanted to take, I could see the stochastic clearly that it looks like it was at the top. Let me just see which one of them is it. Excellent. You see, you see, the stochastic was clearly at the top. So then I was like, okay, fine. If it is clearly at the top, it is likely that we will be going down, and then the meaning we will take this down. That's why I entered the market. So there are many this thing indicators you could use. You see, all of this tells me that the stocks at the top is turning down. You see, so if it's turning down, we expect the market to go down with it. AVAX, stocks is at the top. You see, it is likely that it will turn down. If it turns down, let me take this out. If it turns down, as it is turning now, we expect the market to go down. You know, so these are three indicators that generally people would use. There are other indicators that are like sold indicators, which means people have created them. I have one that I use, and it's a combination of a few things. This is called Market Cipher, right? So Market Cipher, when you buy it, it's a combination of many indicators. So let's go and edit it. I'll just show it to you. I won't talk about it. When you go the default reset, that's how it looks when you buy it, the default, blah, blah, blah. But I'm not going to talk about Market Cipher today because it is a paid indicator and that's not what we are trying to aim at. Yeah, we're trying to find free or cheap stuff that still does the job. So the closest thing to Market Cipher is this one, is a TSI. My friend Oswald is a developer, so software developer. So I've been convincing him to create something. It's created it halfway, but it's very busy. So once we'll get to very close to Market Cipher, and then we can all start using it. Okay, so I've finished now. Let me just go and stop the recording, and then we can ask our questions.